doing a second live stream today. Won't be very long. We're going to probably just do like another half-hour video if we can. Wanted to talk about the joblessness. Joblessness is what the Federal Reserve is looking for in order to bring inflation down to their target, if you actually believe they're going for a target, or if you actually believe they're trying to bring inflation down. Unemployment, or at least the jobs within the economy, is how the Federal Reserve would try to adjust the inflationary scenario that we would be experiencing within the economy. Now, typically the Federal Reserve, or at least what people would expect coming from the Federal Reserve, is that when they lower interest rates, that would spark people's attention to go out and buy houses and cars and go on vacation. I have stated this many times myself, and this is generally how most people see it. However, really what the Federal Reserve is doing is they're lowering interest rates to try and get business investment. When the businesses go out there and start borrowing money to expand on their operations, buying buildings, equipment, hiring people, it's that hiring of people that increases the employed people, increases the amount of income and amount of people who can then add to the consumption. That's really what they are doing. They're adding to consumption by having people working. So the more jobs that are out there, the lower the unemployment, the more people are working, the more consumption that can take place, supply-demand imbalances, and you start having inflation. Now, this is the way the Federal Reserve had conducted themselves for a very, very long time. And really, when you think about some of the things that had taken place, like back, in the early 80s, I remember like movies, like, what was it, Take This Job and Shove It, or even like later on, what was it, Gung Ho? Remember this, where they were like bringing in like Chinese production and all this other stuff? It was always in the name of saving jobs or trying to keep employment. And when you think about some of these massive layoffs that would take place back in the day, when you think about some of these massive layoffs that would take place back in the day, people would be like really concerned. They would be losing their minds, unions going on strike and, all this bad economic times taking place. Well, you really think about it, the Federal Reserve at that time was actually looking for that scenario. They were looking for that rise in unemployment to be taking place to bring the inflation down, to try and bring the consumer down. And this is what they are really anticipating taking place now. They have what they refer to as the neutral employment rate, or the neutral, I think it's the employment rate is what they refer to it as. And this is where the employment is neither accommodating nor restricting the economy. Well, here's something that's really interesting about it is that the employment rate being very low, the neutral employment rate or unemployment, I forget exactly how they refer to it as if it's unemployment or employment. I think it's actually the employment rate. But the employment rate, the neutral employment rate is really low, meaning, or the unemployment rate is really low. Meaning that if you have a very low amount of unemployment and it's the neutral unemployment is low, then what you have is a lot of jobs taking place out there, and that jobs that are taking place is not creating the inflationary scenario. And this is where the Federal Reserve was really noticing that their monetary policy was failing them. So you think about it, back towards the end of the Obama administration and pretty much all throughout the entire Trump administration, they kept talking about all the awesome low unemployment, like the best jobs numbers in history, and they were very much bragging it up as being a really good thing. And as you think about it, most people out there having an option of a job besides the one that they have and an easy skip from one job to the other seems like it's a pretty good environment to be in. But really, that is not a very competitive place to be, as really the idea of having competitive wages and having the ability to then, as far as a boss goes, the ability to then keep an employee for a significant amount of time, retraining people and stuff like that. So if you have people who are skipping out on jobs or just leaving jobs and jumping from one to the other, you don't really have the ability to have a staff or an employee who is really good at their job, who've been doing it for like literally years, like a seasoned employee. And so this is kind of an issue for a lot of the businesses that were taking place out there. As a worker, it was awesome, right? It was like the best environment in the entire world. You had all these opportunities to go out there and just find jobs in just about any field you wanted to. There was always hiring taking place. There was like 2 jobs for every person looking for one. And so that was really like an awesome place to be as far as a worker goes. The Federal Reserve was looking at this, going, scratching their head, going, oh man, we have all this low unemployment taking place and the inflationary scenario is not happening. This is a bad sign. It's really showing that the ineffectiveness of monetary policy to then be working at that time. And it was proving itself. The Fed was scared. They were scared of the fact that they could not find an inflationary scenario. They were like, holy moly, we got the best jobs numbers in history. We just did all this quantitative easing, printing all this money. There is zero reason for there not to be just a massive inflationary scenario, except that the interest rates were incredibly low. Now, again, this is like, it's pretty difficult for a lot of times for people who are trying to just get into this, into the understanding of economics, because the story is so long and it's so twisted. But coming towards the end of 2019, we had incredibly low interest rates, even though the Federal Reserve was raising rates up to 2.5% on the Fed funds level. It was still historically very, very low. And low interest rates is a deflationary environment. A lot of people don't realize that. When you have a return on capital investment that is incredibly low, and then after your purchasing power has been deteriorated over the years, it actually goes negative. Low interest rates on capital investment is a drag on the economy and is actually a deflationary environment. And this is very much what we were experiencing towards the end of 2019. And again, like the Federal Reserve was just like, man, what is it we're going to do? So now we have this huge increase in inflation. So we're just going to skip ahead real quick through all the pandemic and all the severing of the supply chain and everything that took place there. Because what we ended up with was an elevated inflation expectation that really drove the inflationary scenario that we are experiencing. Like, you think about it today, the money didn't go away, right? I mean, like, what? They retracted a little bit. Quantitative tightening took some money out of the system, but not a lot, right? And the amount of money that was printed was supposedly going to throw the entire, system into a hyperinflationary scenario that was not going to be able to be stopped. This is what a lot of people believed. Well, here we are, moderately above 2%, the Fed's target, supposed target, anyway, modestly above 2%. And the money printing really hasn't been retracted that much. The quantitative tightening didn't pull that much money out of the system, but the inflationary scenario seems to be falling quite a bit. Now, we think about this for just a minute. It was just like the unemployment, right, has not risen that much. Like, it's up some, and considering what it was over the last few years, yeah, it has risen. But you look at it at a historical basis, like, it is still incredibly low. Many times throughout history, it was, in fact, for the most of history, it was far above this level. So when you think about the low unemployment environment that we are still experiencing right now, and the fact that inflationary scenario is starting to come down, even though there's the threat of it ramping back up going into the future with the tariffs and, supply chains and all that other stuff. Right now, what we're experiencing is, again, low unemployment and an inflationary scenario that is coming down. It should be high unemployment that brings the inflationary scenario down. But since the Fed's monetary policy doesn't work anymore, right, it doesn't function in the same fashion. So now when we think about the Federal Reserve conducting themselves in the way that most people are anticipating that they would, right, because the Federal Reserve is mandated to do 2 things: low inflation with stable prices, in full employment. That's their dual mandate. Now, if you have an unemployment situation that is still historically low, even though it is rising some, and I imagine that most people, and you'll probably see it in the comments, will be jumping and screaming saying they disagree with the actual official unemployment numbers. And yeah, that's probably pretty true, but we're trying to figure out what the Federal Reserve is doing with monetary policy. And they see it as unemployment being very low, an inflationary scenario coming down without necessarily raising the unemployment significantly, like you would typically have expected coming from the Federal Reserve. So you can see how they are now conducting themselves in a new fashion. See, like back in the day, we would have had a rise in unemployment to bring the inflationary scenario down, but they don't need to raise the unemployment significantly. They can maintain their dual mandate and deal with the inflationary scenario in a whole new world of monetary policy because it doesn't function the same way that it used to. People are going to look at the unemployment and they're going to say, hey, man, it needs to be, or not needs to be, the official number needs to be stated much higher than it is. And I agree with that. Like I would say, yeah, we probably have a lot more people who are unemployed, not in the workforce, who are not being counted as unemployed, but are a drag on the economy, bringing it down. I would totally agree with that statement. However, again, we are not trying to figure out exactly what is happening within the economy to the idea that the Federal Reserve should be conducting themselves in a different way. Like I would love to do that. I would love to say, hey man, the Fed needs to look at this and these things and then start judging their monetary policy based on those things. I would agree on all that stuff. The problem with it is that the Federal Reserve is never going to listen to me. They're never going to listen to you. They're never going to listen to us, even if we were to voice our opinions very clearly and loudly to them. They still would not be listening to us. So now it's us to be the ones to listen to them to figure out what it is that they are doing, even if it is messed up information, to try and figure out how it is that we conduct ourselves in that environment. And that's really how I'm starting to see this thing, is that the Federal Reserve is using their words, the forward guidance, as more of a monetary policy tool than anything else out there. The more I look at this, the more I see it that way. When you see that the unemployment has stayed significantly low over the last few years and even decades, when you go and I left a link down in the description if you want to go look at it for yourself. But if you think about this, this should not have brought the inflationary scenario down. It shouldn't have worked that way. It's never worked that way in history until now. Why? Because the monetary policy is no longer functioning the way it used to. People don't realize that, right? They don't know it. Most people don't know it. The most economists, mainstream media, talking heads out there, and I would imagine even most of the politicians who probably never really had a clue to begin with, have no idea that the Federal Reserve is no longer able to conduct themselves in the way that they had grown up believing. Now, once you recognize it and you see it for what it really is, that it's a credible threat that is really being applied to the economy, how it is that people take this information and how they conduct themselves with that information is really how this monetary policy is being conducted. Our expectations of inflation has more to do with the outcome than anything else out there because of the way that we conduct ourselves with that information. If we believe that there is inflationary scenario coming, if we have the credible threat of tariffs, we have credible threat of supply chain breakdowns, credible threat of war, disease, anything out there, we will begin to behave ourselves in a way that starts to create that scenario. It's a self-fulfilling prophecy. And it's hard not to see it when you are stuck in the middle of it, watching it all happen, and you're not clued into the credible threat. If you're not clued, I mean, you might recognize this as a credible threat, but to apply it to the monetary policy is a very difficult thing if you are not already privy to it. Like if you have already recognized this is how they are conducting themselves, it makes it almost impossible to see it any other way. But if you are not clued into it, and if you are looking at it like they are making snap judgments, it makes it very difficult to understand how it is that you can position yourself to deal with the future inflationary scenario when you believe that it's about ready to destroy your life. it makes it very difficult. Like most people take in the information, they're like, oh man, I got to protect my wealth. I got to protect my food. I got to protect all this stuff. And they're like, inflation is going to destroy the entire thing. Hyperinflation's coming. Weimar Republic, Zimbabwe, whatever you want to call it. It's all happening now. And I was one of the few people out there who was so adamantly saying, don't fall for it. Don't fall for this situation that is happening right now, because if you are falling for the inflationary scenario, believing that it's going to turn into a hyperinflation scenario and that it's going to destroy the entire monetary system, you're actually working in benefit of the Federal Reserve, who was in desperate need of inflation. And once you see it, once you recognize it and know it, then it makes it a lot more obvious to why it is that they are doing the things that they are doing. How it is that the monetary policy of the Federal Reserve, which once was an adjustment of interest rates, has now turned into forward guidance and signaling. You can even see it now, like the whole idea that they're going to step back or pull back on the idea of cutting rates going into 2025. Like, how many people would have believed that that would have been the case at the end of 2023? It wasn't a matter of if, but when they hit zero again. Like, nobody had an idea that they were going to be reversing in 2025, right? Like, I mean, some people might have thought that, and they might have, like, whatever. But for the most part, everybody in the mainstream, throughout the talking heads, everybody was like, how much, how far, how long will it take to get back to zero? All right? Even though the Federal Reserve the whole time saying, hey, we're trying to get to neutral. And getting to neutral may be something that actually comes to them instead. And if you have an inflation expectation that is elevated going into the future, it very well could turn out that the neutral interest rate, not the neutral employment interest rate or the neutral employment rate, the neutral Fed funds rate, where the Fed is neither accommodating nor restricting the economy, they may end up finding that the neutral interest rate will find them. And that's one of the reasons why they're backing off on the whole idea of cutting rates going into the future, because if an elevated inflation expectation raises the neutral interest rate and we have a continued elevated inflation expectation going into the future, especially with some of the things that the future administration is promising, I could only assume that we are eventually going to be running into neutral, or that the neutral interest rate will run into the Fed funds rate, or they will come very close to meeting each other in between. Once I seen it this way, I had very little belief that the Fed was actually going to be lowering rates much. I said it was a long time ago. I said they were going to stay elevated, higher for longer, getting high and staying high. It's because their monetary policy isn't about the interest rate adjustments. It's about the talking of interest rate adjustments. Okay? And if you have low Fed funds rate, if it's at zero, you can't really talk about the adjustment of interest rates if you can't adjust them. But if you have the elevated elevated Fed funds rate, now you have the ability to talk about it, regardless if it does anything. You can't talk about it if it's at zero, but you can talk about cutting or adjusting if it's well above the neutral interest rate. And that's exactly what we are experiencing now. There will come a time in which the neutral interest rate will be met. The Fed funds rate will meet the neutral will meet the Fed funds rate one way or the other. It's going to happen. When it does, nobody's going to recognize it. Nobody's going to know it's taken place. And then by the time that is recognized, it'll be too late and it will be on one side or the other. And the Federal Reserve will have to adjust monetary policy at that time. Nobody really speaks of it in this fashion. We don't know how long it's going to take, don't know what it's going to look like, what the new game plan will be to try and stimulate the economy, especially if the neutral interest rate happens to be low. Right? And the Fed funds rate is low. That makes very little room for actually stimulating the economy again with the adjustment of rates. So in my mind, it's a big waiting game to see what it is that the Fed is planning on doing with their new long-term policy strategy, their 5-year plan. This is something that we had just recently talked about here, on this channel. They haven't really communicated what it is that they plan on doing, but they, as far as their communication about being moderately above 2% for some time, I think we've achieved that, and maybe we will continue to have it moderately above 2% for some time. Continue on with the makeup strategy. Continue on with flexible average inflation targeting, or it may change. But since most people have no idea about flexible average inflation targeting, they wouldn't have any clue if it did change. Right? But we're going to be well aware of it. We're going to be on top of it. Alrighty, guys, I'm going to give it like another 10 minutes here, and then we're going to call it quits. We got 298 people watching with 52 likes. If you enjoyed the video, please hit the like button. By hitting that like button, the YouTube algorithm will pick it up and spread it around for more people to join in. I'm going to keep going with this information. I'm not going to let it go. I know I sound like a broken record. I repeat myself a lot, but when we're dealing with some of the things that we are dealing with within the economy today, I just really feel that by reiterating this information, by constantly bringing up the credible threat theory, we can begin to recognize it on a daily basis in our daily lives, how it is that we can position ourselves accordingly for it. All right? If we don't recognize, if we don't see it, we're going to be, lost in the idea of, things like hyperinflation scenarios that never seem to manifest themselves. And at the same time, you actually see the US dollar index growing in strength. Right, getting stronger than just about any time. There's only been a few times in history that the dollar has been any stronger than it is right now. That's crazy to think. Most people thought it was going to fail. Like a lot of people thought it was going to be done by now. And here it is, comparatively to a basket of world currencies, it's sitting stronger than just about any time in history. Only a few times has it ever been stronger than it is now. I remember how many times I was told that what I am doing is sharing dangerous information. Can you believe that? When inflation was running at its peak, and I'm telling people, beware of this strategy that the Federal Reserve is now using to try and save their monetary policy, and it has a lot to do with elevated inflation expectations. I was trying to warn people about it. And I had people commenting saying what I was doing was dangerous to the people. By giving them information like I was doing was somehow dangerous to them because they would not protect themselves from the inflationary scenario. And I'm thinking at that moment when I was reading that comment, right, if you had not already protected yourself at that point, it was already too late. Inflation was already happening. If you had not positioned yourself by that point, it was already too late. We are on the other side of it. It's coming down. Right? And I'm not saying that you shouldn't protect yourself from an inflationary scenario that could possibly come, but to believe that it was a hyperinflation that was coming and that there was no way that the dollar was ever going to last and that it was going to fail and all that other stuff, it didn't happen. All these people were wrong. And the one thing that it did do was benefit the Federal Reserve. They needed that belief. They needed the people to believe that there was going to be elevated inflation. Without it, they would have failed. And I don't know how many times I try to bring that up and tell people about that. And the only thing that they say is they did it on purpose and they're, want you to fail and lose and be miserable and, suffer in pain and misery and slavery and all this other stuff. And I'm like, yeah, well, that's probably where you're going to end up headed if you don't position yourself appropriately. And since that's what you believe, then that's probably where you're going to end up. All right? So I don't look at it that way anymore. I look at it and say, okay, how do I position? How do I figure this out? How do I know that I'm going to be okay with the investments that I've taken, knowing that there's not going to be a hyperinflation scenario, not this time around, not like this, because it can't go down like that. I mean, I envision a hyperinflation. I do. Like, don't get me wrong. But I believe it's going to come from a world collapse in US dollar denominated debt. I believe once the people of the globe decide that they are no longer going to accept dollars or write debts in dollars. The problem with this is nobody's doing that. Now, you can put some BRICS nations together and say, we got a handful of people who are coming together with some ideas on how it is that they plan on doing some trade with each other. Hey, that's a great story. That's wonderful. But none of those nations, not a single one of them, is going to be able to do the things that the United States is doing. And mainly that is provide the world with the safe and liquid asset of the U.S. Treasury. I'm not trying to claim it as a safe and liquid asset. The world does that. Right? The world does that on our own. I'm not trying to advocate for it. I'm not trying to say, hey, it's a good or bad thing. What I'm saying is I can look out there and I can see that the world is in demand of US dollars, and they are demanding it for a safe and liquid asset like the US Treasury. None of the BRICS nations, none of them want to take on a position in which that they are going to be the issuer of debt, not like the U.S. Treasury is. And I know that everybody's looking at it saying, oh, dude, they can't hold on. They can't maintain this debt. They can't do all this other stuff. And I totally agree. And I've been agreeing with that for like 20 years now. All right. I've agreed with that for like 20 years. I position myself to deal with the collapse of that. If that happens, hopefully I understand it in a position in the way that my position can then benefit me. I'm not looking forward to it and I'm not expecting it. How they deal with that situation, I have no clue. But it seems that they continue on able to kick that can down the road yet again at everybody's disbelief. And if they can't do it one day, I hope I'm correct with what I have done with my positioning. And if I'm expecting what it is that I am expecting, that I'm going to can hopefully have positioned myself with stocks and bonds and real estate or whatever to take advantage of the fact that the money printing system is going to continue on, and that the separation between the rich and the poor occurs because of the new money increase. And if you have this happening on a regular basis, then you're going to have an incredible amount of separation between the rich and the poor. And there's really nothing that you can do about it unless you wanted to sit there and wait for that doomsday scenario that may never come. So what are you going to do outside of become a capitalist or property owner yourself? Man, I'm really babbling on here. What do we got? 329 people watching. Then what we got? 80 likes. Go hit that like button, everybody. We'll continue on with this for a little longer. Since 2008, when I started a Roth IRA, I just added more accounts like a taxable brokerage investment account. I have no college degree, but I have a Lord Savior, Jesus Christ, who already won. Yeah. And I agree, like starting early is the key to all that, you know. I mean, being young, that's the one thing, like I mean, anybody who's watching, like most of the demographics of my channel are people who are like in their 30s, 40s, 50s, going into their 60s or whatever. Like it's older adults, but really like I noticed that there was quite an increase in younger viewers. Like, and it's surprising. I think really COVID had a lot to do with it. But over the last few years, there's definitely been an increase in the younger viewers who are coming to the channel. And I like, if there's any advice that I could give to them, because I don't try to give financial advice in any way. I just try to look at things from my own perspective and try and help for you to, you know, see it from your own perspective as well. But if there was one bit of advice that I could give to the younger crowd is to take advantage of compounding interest early. The earlier you start, the better. There's no greater gift to an investor than time. And if you have youth on your side, you have something that nobody else has, and that's the time. Because most of us who are in our late 40s, going into our 50s or 60s, who haven't figured it out yet, are going to have a hard time taking advantage of compounding interest. By the time it actually does any good for us, it'll already be too late. We won't be able to really enjoy it. So I'd say start early if you can. You know, that's the only, like, when it comes to financial advice or investment advice, you know, that's the only one that I will give, and I give it to the younger group. All right. Compound interest is the eighth wonder of the world. He who understands it means or earns it. He who doesn't pays it. Yeah, Albert Einstein. Yeah, and that's totally true. I totally get it. All right, I liked it for you. Repeat, keep going. Also by Sholo and Sifi. I can't even read that. Fee. I can't. I'm sorry, guys. I can hardly read this. Big gains coming. Okay. I teach my children you can't afford not to invest. Yeah, that's true. I hate selling my BTC, but at some point I'm gonna need the cash. Well, ZN, if you're not, if, I mean, not to try and give you financial advice, but borrowing money against your BTC, you don't pay taxes on it. You'll pay interest on it, but you don't pay taxes on borrowed money like that. So you can keep your Bitcoin and still have access to the cash at times if you wanted to use it to start a business or something. That way you can pay back the loan and have access to the cash or something, and just keep your Bitcoin if you can. But I mean, everybody's different. Yeah. All right, buying penny stocks is a good way to go broke. Yeah, I agree. Hey, right on. We got Bobby Bobberton. I love the name with the 4.99. Thank you so much. How do people behave with high inflation expectations? Well, see, that's just the thing. People have these high inflation expectations. Think about what it is that you're going to be doing, or what your subconscious is going to be telling you to do, right? Because this is a lot of times people end up acting what they feel is on instincts, but really it's built-in internal subconscious behaviors that have either been developed since childhood or something that you have developed from like the brainwashing of mainstream media or something of that nature. So I mean, like, what was it that some of the people were believing with I mean, were you thinking hyperinflation or just a high inflation? Just a high inflation expectation. I mean, people were buying a lot. Like, I had a guy contact me one time, say, hey man, I love what you do on the channel. I'd love for you to come on, do an interview. He says, hey, how would you like to earn 10 ounces of silver? Like, I think he was going to do a 10-ounce bar for giving literally like a 30-second shout out to his company, right? And he was just like, and I thought about it for a little bit, and I was like, this is pretty interesting. And then he goes on to talk about all the reasonings to buy silver. And he was talking about how the Fed is going to destroy the dollar, inflation, all this other stuff. And I'm like, dude, you realize that everything you're telling me to use for a reason or an excuse to buy silver is completely against everything that I believe is coming from the Federal Reserve and their monetary policy, right? And he had a hard time understanding, because that wasn't, I'm sorry, the interview I had done, it was another group that these were people were affiliated with that had approached me about doing the commercial, right? And I'm like, you guys obviously don't pay attention to my channel, right? You don't watch my channel. You're like out there pushing this silver bit, saying that it's going to protect people from hyperinflation. I think that's like very much a pump and dump type of scheme, right? You shouldn't be doing that kind of thing. And the guy was actually kind of taken back that I was like, so adamant about it. It was just like, I'm not going to tell people to go buy silver to protect themselves from inflation. It doesn't work like that. It never has for me. Eh? Like, I bought a lot of it. In fact, I won 100% in the silver back in 2010, believing that we were running into a hyperinflation scenario. I mean, I thought for sure there was no way that we weren't. And when it ran up to $50 an ounce, I thought I was the smartest person in the entire world. I thought everybody should have listened to me. I am so smart. Everybody's got it wrong. Dollar is going to fail. Silver is proof of that. Ha ha. That was what I thought. And then I watched silver go from $50 an ounce all the way down into the teens. And I thought to myself, man, I really couldn't afford that. Like, now I'm completely under on my silver. And all this money that I had put into it, thinking that I was so smart, is now essentially gone if I sell it. I didn't feel good about that. And so when this guy is popping up saying, oh, dude, you got to tell people to buy silver to protect them from inflation. And I'm like, no, I'm not going to do that. I mean, I'll tell them to buy it to get themselves out of a third-party claim so that they can protect themselves from the system and have something in their possession that is not up to a phone call or an app or anybody else out there. That's what I'll tell them, that's what I'll suggest buying silver for, but I'm not going to tell people to buy it to protect themselves from inflation. It doesn't work like that. So as I saw many people behaving in such fashions because of the future inflation that could possibly come from the expectations of it, I saw that they were making a lot of, in my opinion, inaccurate decisions. I didn't have any problems holding on to cash during all that. As everybody was saying, cash is trash and cash is worthless and all this other stuff. And I was like, okay, yeah, I could kind of agree with that for the most part, that cash is trash because it, deteriorates over time as far as the purchasing power of it goes. But as far as going into a hyperinflation scenario and my $100 bill go floating down the streets because nobody's going to want it and there's going to be wheelbarrow full of money and stuff like that? Not yet. Well, I don't believe that yet. In fact, I believe that there would be buying opportunities coming into the future if I was just to hold on to my cash for a short amount of time. And what did I end up finding with that belief is that the lumber industry, which is the one that I truly focus in on, I mean, the one that I really focus in on, the only one really actually, is now at a price that is below that of 2018. In fact, it's like 2017 prices. Like all the inflationary scenario that everybody was pointing at lumber, saying, look, money printer go burr, prices go up, and they were pointing at lumber. And I was like, don't do that. What are you going to say when lumber goes back down to its normal price? Here we are. Right? Silver sitting at like just about 50% of its all-time high. Oil is like 50% of its all-time high. Lumber's like a third of its all-time high. All these vital commodities that are, desperately needed for mankind's use are all sitting at an incredibly low number. And people want to look at it and say, yeah, dollar destruction, dollar go bye-bye, and all this other stuff. And I'm like, buy a bunch of oil with it right now. You can buy a bunch of lumber with it right now. And people don't, but they could buy a bunch of silver with it right now. Man, 347 people watching. I don't want to quit now with all these people coming in. I tell you what, we got 113 people watching with 347 or 113 likes with 346 people watching. Get it up to 200 likes in the next 4 minutes, and I'll stick around for a little while. Otherwise, we'll cut this at 40 minutes. So that's a lot of you. You all have to go and hit the like button right now if you want me to stick around. All right, we don't use as much wood and oil as we used to use. More, what is that? Germanium, gallium, and etonium than ever before. Yeah, I'm not going to agree with that. I think the lumber use is incredibly high right now. So, I mean, not at this exact moment, but in generally speaking. So, no. And I think oil is also incredibly high in demand. The production of it, I believe, is also incredibly oversupplied. So, all right, UE. But what if we see a bull market in commodities and the other nations start dumping treasuries slowly? I mean, it's happening for sure. But what could take a decade? No. Okay, well, let's take, for example, just a minute, why it is that these other nations are dumping treasuries, right? Because a lot of times we take it into consideration that they are dumping treasuries to get out of the dollar, right? But that may not necessarily be the case. Now, and a lot of times what you are seeing is that they are trying to get out of U.S. treasuries, not to get out of the treasury, but to get into cash. And the reason they need the cash is because they have debt obligations that are also due in dollars. So the best way to get dollars is to sell U.S. treasuries. And so as we have a slowdown in economic activity, especially like conditions like you're seeing out of China, where their manufacturing is slowing down, the exports are very difficult, especially coming to the United States, and China is facing these problems. They have debts that are due in dollars. They have written government bonds, and not even just the government done it, corporations have done it. It was one of the reasons why Evergreen, what is the name of that? Evergreen? That's the name of the developer over there? I can't remember offhand. Evergreen, something like that. Anyway, this was one of the reasons why they started falling into default, is because their dollar-denominated debt, right? Both the Chinese government and the corporations within China do this. When that dollar-denominated debt comes due, they need to acquire dollars to pay it back. If they cannot acquire the dollars to pay it back, and that portion of their debt starts to go into default, it starts to drag down the entire credit rating of that particular company or government. And so when you think about how it is that these operations end up taking place, and that if they have a slowdown in exports of material going to the United States, that's less cash that's coming in. If they cannot take that cash and pay back their dollar-denominated debt, they need to figure out a way to get cash. And if it's not through the supply of manufactured goods, it has to come from their savings, which is those U.S. treasuries. And this is one of the reasons why they end up dumping out a lot of U.S. treasuries, is because they do not want to see their credit rating fall. And so they have to pay that dollar denominated debt, that portion of it. This is not something that is explained. They do talk about how they're dumping out of treasuries and say, oh, look how quickly they're getting out. But then they don't explain why, or if that would be the case, or how much dollar denominated debt is coming due at that time. And so once you kind of start looking at it in this fashion, you start to realize, man, the demand for dollars is a hell of a lot higher than people are giving it credit for, right? And so I don't see a situation in which that would be taking place. Like, there could come a time in which that people are getting out of U.S. treasuries in order to get a hold of those dollars, but then you think about it, what is that doing to the dollar, right? It's creating a demand for dollars. It's making the dollar stronger. Right? And that's probably one of the reasons why you're seeing the U.S. dollar index rising like it is. You know, what does that do? It makes it cheaper for the United States to buy those manufactured goods from the world. I mean, there is a million what ifs, right? Like, I'm not trying to dismiss the what if scenarios. Like, they could happen. And that you could have a position in which that, you know, all of a sudden everybody is getting out of these dollars. They're defaulting on dollar denominated debt. They really want to get out of it and stuff. That very well could take place, but I don't see it happening yet. All right. Like, there's, you know, evidence of it possibly occurring in the future at some point through some of these partnerships that are taking place. And I agree. But again, like, it's such an insignificant amount that is happening out there that until it actually starts to increase in a major way, which I don't even see how it could, I give it very little consideration in what it is that it's going to do for my investments, for my jobs, for everything else. As time goes on, we will see the evidence of it being something more prolific or not. Right? I mean, you think about it. Saudi Arabia and Turkey have both denied the acceptance into BRICS. They're like, nah, we're going to stick it with the United States and their system. All right. All righty, guys. We got some super chats. Well, that's another way of keeping me here. Hit me up with them super chats. All right. Bobby Bobberton with the $4.99 again, man. Thank you so much. I'm trying to understand what the Fed is attempting to accomplish by projecting a higher inflation expectation. What economic outcome do they want? You know, it was the one that they failed to have at the time. So I think it's not so much like they're trying to do it for a future outcome as much as they were trying to deal with the fact that they couldn't achieve a certain outcome from the past. Okay, let's rewind it back a little ways. The Federal Reserve was at the lower bound of zero. Now, the lower bound of zero is literally meaning that the Federal Reserve, the Fed funds rate, is at 0%. If they were to go any further down, they would be negative, right? So they cannot go any further down than zero. Now, after the great financial crisis, right? Quantitative easing 1, 2, 3, and 4, all the money printing, all the stuff, right? That should have created an inflationary scenario, failed. It failed them, right? So here the Fed funds rate was at zero the entire time, and they could not get inflation. They could not get the inflation expectation to be elevated, right? So now this is a problem for them, because now they're about ready to run into an economic downturn and with no room to move because they're at zero, right? So if you have a slowdown in economic activity and you need to stimulate the economy, typically the way that you would do it would be lowering the Fed funds rate. And by lowering the Fed funds rate, that would spark the business investment to go out there and do the hiring and get people working again. But when you're at zero, you can't even threaten to do it, all right? Because you have no room. You're out of tools. So the Federal Reserve attempted to try and get that ammo back. See, this is like, think about it like ammunition, right? And if you have the ammunition, then you will be able to fight the problems that are coming. And now, when you think about the ammunition, that is the adjustment of the Fed funds rate. So if you have the Fed funds rate very elevated at 5%, that gives you a lot of room to move. Now you got ammunition, right? So the Federal Reserve desperately tried to get some ammunition back During the Trump administration back in 2017, 18, going into 2019, they were on what they referred to as autopilot. I don't know if a lot of you remember that, but they were raising the Fed funds rate a quarter point every quarter, regardless. They were just like, hey, we're sitting on our hands and we're just going to allow this to take place. Well, it started ticking up, right? Systematically ticking up. Well, it got up to 2.5%. Everybody was losing their mind. And the Fed was like, crap, that's not very much, right? We didn't get a whole lot of our ammunition back. Now, the major problem that they were facing at the time, again, is because there was no inflation. No inflation. The Fed should be printing money. Donald Trump said that the Fed should take interest rates into negative territory and print money, right? There was no inflationary scenario for the Federal Reserve to try and combat. So without the elevated inflation expectation, their Fed funds rate was going to remain very close to zero, which means that they had no more monetary policy to adjust the Fed funds rate with in case of a downturn in the economy. They were stuck. They were like screwed. This is them talking about it at the end of 2018 going into 2019. They were like, crap. What do we do? If we had an inflation expectation that was way up here, we would be able to raise the Fed funds rate in order to combat that inflationary scenario. Without the inflation expectation, there is no inflation that is going to take place. So by creating an inflation expectation that is well elevated and well anchored at 2% going into the future, that gives the Federal Reserve the ability to conduct themselves through that interest rate adjustment. But in the end, it's not even a matter of the interest rate adjustment. It's the ability to talk about it. So again, this is the problem that the Federal Reserve was facing way back during the Great Financial Crisis, is that when the Fed funds rate hit zero, they were done. Monetary policy had come to an end. It was finished. They started using their words, forward guidance. They started coming up with the dot plot. They came up with press conferences. They came up with all these communication styles in order to start projecting out there what it is that they planned on doing going into the future to try and create the monetary policy tool that would be useful to them, because the interest rate adjustment wasn't going to work. So it started coming down to communication. And so without that elevated inflation expectation, there is no way that they would be able to lift off the lower bound, get the elevated Fed funds rate, and then have the ability to talk about the adjustment of it. That's the problem that the Fed faced. Ben Bernanke's speech talking about deflation and how to prevent it from ever occurring here, it was November of 2001. He goes into describing it. He describes the situation that was faced during the Great Financial Crisis. He described it back in 2001. He described what it is that they needed to do to prevent it, and if they couldn't prevent it, what it was that they were going to have to do in order to combat the situation that they were going to face. He talked about the asset purchases. He talked about taking the Fed funds rate to zero and going into massive asset purchases, meaning buying up those U.S. treasuries. He was describing quantitative easing back in 2001. They knew that they were going to be facing these problems. Once you see it, once you recognize it for that, right, that the problem was faced years ago and that they had hit that lower bound of zero and no longer had an effective tool for stimulating the economy. And so they started using their words to guide the markets, and that became their monetary policy. The only problem with using their words to guide the markets is they have to have a credible threat behind it. In order to have the credible threat, you can't have the Fed funds rate at zero. You have to have it elevated. And in order to get it elevated, you have to elevate the inflation expectation. I don't know, did I explain all that? I can keep going. I can keep going in circles on this and keep rehashing it out there, but I think that's the only way it can really be explained. All right, guys, this was a lot of fun. We're like almost 50 minutes into it, way over time. I really appreciate everybody being here tonight. We got 302 people watching, a bunch of likes, 156 likes, and $9.98 in super chats, because Bobby is very supportive of the channel, and I really appreciate those super chats, the support that you guys have shown for the Uneducated Economist over these years. I can never thank you enough for it all. We're going to keep coming out here. We're going to keep sharing this information. We're going to keep sharing this strategy and the idea of what it is that you can do with this information, considering the position that you have taken with your life, the skills that you have, the abilities, the network. All that stuff is very much unique to you, and to understand the economy for yourself so that you can make the best and most appropriate decisions is by far the only way to take this information in, is to take it in a personal fashion, not one that says, hey, give me the generic cookie cutter answer I'm looking for, because that's never going to lead you in the right direction. Only you will lead you in the right direction, and you can do that by taking in the information and understanding it into an internalized position. And by being able to explain it, you have internalized it, and I assure you, your subconscious will start helping you make the right decisions. Okay, Uneducated Economist, you guys let me know.